Joining us is a special guest live. Michael Kurtz, Chief Asia Equity Strategist at Nomura, joins us from Hong Kong. Michael, thanks so much for taking the time out and joining us for this interview. First up, this rally globally seems to be completely driven by a phenomenal amount of liquidity. What are the risks then, do you think, that could in a sense play a party pooper from here on? Do you think the geopolitical tension could in a sense dent investor confidence and affect liquidity flows globally?
Yeah, without a doubt, Europe remains the primary risk, and it's unfortunate the degree to which Greece has come back to the fore now as a critical driver of emerging market risk. But we do think that markets have had a very long opportunity now to sort of get their arms around the Greek uncertainties. And we don't think that even a Greek exit from the euro, if that were to happen, and we don't believe that it will, but we don't think that it would necessarily be as big a problem for emerging market stocks as it would have been 4, 5, 6 months ago. You mentioned Iran, and I do think that oil prices are potentially going to be a spoiler for this market rally. Again, it's not our core view, but if we look at where the risks lie, it's really a combination of both political tension in the Middle East, as we saw indeed last year around this time when oil prices at that time were a real headwind for Asian equities. But beyond Middle East tensions, it's also the fact that we've got growth in the U.S. picking up again. We have very loose monetary policy conditions around the world, with the ECB printing money, the Fed still tilting in the direction of printing money, the Bank of Japan having announced that it's doing further quantitative easing, and all of that monetary ease combined with a pickup in demand in key economies like the United States should also tend to drive oil prices and other energy prices higher, and that itself is a risk to the growth outlook and to stocks.
Michael, hi, afternoon. So what is the equity strategy that you're advising to your clients given the equity rally that we've seen across the globe?
We do think the recent rally is really only, roughly getting us to, say, the 4th inning of a 9-inning ball game, and that there's still more to come. The driver of the rally, we think, is changing. In the first 4 or 6 weeks of the rally from mid-December, it was really all about a repricing of risk. We simply thought that some of the worst-case tail risk scenarios by the end of 2011 had become too embedded into equity prices. So this was the market basically putting too much emphasis on the possible euro area breakup, the possible hard landing in China, or the possibility of a double-dip recession in the United States. And that created a viable overcorrection in the market. But now we think the market is being driven more by real money flows. Investors didn't really get the chance to participate in the early weeks of the rally because market volumes were too low. Now that volumes are picking up, investors are really starting to put money to work again. And if we simply look at how much money has come back into Asian markets since the beginning of this rally and compare it to historic examples, we find that we could be as little as a quarter and probably no more than halfway through. And that means at least potentially another 15 to 20% upside for the regional index, suggesting investors should stay long beta, long some of the more cyclical names in the region, materials, energy, industrials, certainly financials where we still see a lot of value, and for the time being not rotating back into some of those lower beta or lower cyclical names in, for example, utilities or consumer staples where we just don't see enough value.
But what about Indian equity markets? I mean, they've risen by nearly 20% on a year-to-date basis. Do you think there's more steam left in this rally? Indian
valuations are beginning to come under a bit of pressure, I think, in that they're no longer as screamingly cheap as they were 2 months ago. We came into 2012 with a neutral recommendation on India, but we were emphasizing neutral as opposed to underweight because we thought that Indian stocks had gotten cheap enough that investors should no longer be underweight in that market. But from here, we find that Indian valuations at roughly 14 times forward earnings are effectively in line with long-term averages, and so that value proposition is not there. What we're going to need, I think, to open up more headroom for Indian stocks on a medium-term basis is to start seeing some earnings upgrades. And I think what we're going to need for that is for monetary policy to start to loosen. So we're looking into the second quarter and then beyond that into the second half of the year with a view towards watching RBI interest rate policy more than anything. And here there is good news. We see, for example, wholesale price inflation dipping below 7%. We think it's probably going to hold within 6 and 7% over the next year. And that should give RBI enough of a comfort level to bring down base lending rates by about 50 basis points in the second quarter of the year. And that potentially does, I think, provide the catalyst for Indian stocks to claw higher. So at this point, we do see further upside, but not enough that we would want to go overweight the market at this point. Certainly, though, staying neutral India is justifiable given the way global investors are coming back to risk tolerance again.
Michael, what about FMCG and pharma stocks? Because they've relatively underperformed because of their defensive nature. What's your view on these spaces?
You know, we're not too enthusiastic about the fast-moving consumer good names in India. We've actually got reduced recommendations, for example, on both Colgate and on Unilever. We're a bit split on the pharma sector. We're certainly not as negative on pharma as we are on the FMCG sector. For example, we do have a buy rating on Dr. Reddy's, but Ranbaxy for us is still a reduced stock. And overall, these aren't really the sorts of names that we are recommending in India, which are the names that are a bit more directly tied to monetary policy.
Michael, would you prefer rate sensitives like auto, financials as far as the Indian markets are concerned?
Those sorts of interest rate sensitive stocks are some of the ones that we do like most in India. So, for example, in the auto space, we have buy recommendations on both Mahindra and Mahindra and on Tata Motors. And certainly the banks is a sector where we are recommending buys almost across the board. Our upside targets are moderate. We're only looking for really, in most cases, between 8% and 12% upside for the Indian banks. But we see the catalyst there in the form of inflation coming down and presumably some monetary ease in the second quarter. And we think that continues to put the wind behind those names and takes them a bit higher between now and the middle of the year.